So now you're becoming familiar with adding indicators to your charts. Hopefully you've been able to try a few and look at the information they display against the price chart itself. Let's now move things on a stage further and explore why traders use indicators and how they can help you dig a little deeper into what the price action might be telling you about the market. Firstly, it's important to say that indicators can be immensely helpful in making trading decisions. Once you've practiced and become familiar with how they work, they can become an invaluable part of your trading approach. It's also important to understand they can be very dangerous too, especially to new traders. This is because newcomers approach financial markets with a natural tendency to want to see the indicator itself as a complete solution for making a financial return. They trade directly off the back of information the indicator provides without taking any other factors into consideration. This is a common mistake. Indicators are heuristic by nature, meaning they help a trader solve a particular problem quickly, which they wouldn't have necessarily been able to do without its help. The solution they offer isn't perfect, but is considered good enough to get the job done. The best way to visualize the role an indicator provides is very much like the process a carpenter might go through when building a wardrobe or some other piece of furniture. The carpenter will have an array of tools in his toolbox, all of which do different things. Whilst he's working, he'll need to use each of these tools in different ways to complete specific tasks. No single tool does the whole job on its own. The old adage, "to the man with a hammer, every problem is a nail," is very true when it comes to using indicators to forecast future market direction. So what can traders use them for? Well, they can help in a number of different ways. Indicators can help you look for and confirm turning points in the market. They can highlight when a trend is gaining or losing strength. They can help you look for areas in price action where other traders may be active, helping create levels of support and resistance. They can help you decide when conditions could be right to make a trade or take a trade out of the market. They can even be used to help you identify times when you should not take a trade and stay out of the market. When you start to research any particular indicator, it's always worth finding out a bit about its history, who designed it and why. Try to find out what the problem was the inventor was trying to solve by creating it. This will go a long way in helping you decide if it's a tool you want to include in your own toolbox. You'll also have to go through a process of experimentation too, but remember, the more work and effort you put into understanding the indicator, the more you'll get back in return. In the next section of videos, we'll create a series of brief introductions to some of the most widely used indicators around to get you going. Use these as a starting point for your own research. And don't forget, if you have any questions, you can always send me a direct message or you can ask any of the analyst team during our next live stream.